there. Thanks for tuning into our podcast. I am with Alex Bagne today. Alex is the president of ICS Tax. He's a licensed attorney as well as a certified public accountant. Alex is also a certified cost segregation professional, and he was elected president of the American Society of Cost Segregation Professionals. We'll be talking about cost segregation and how it can save short-term rental property owners thousands today. Alex, welcome to my podcast.
Thank you for having me.
Honestly, I cannot imagine a more qualified guest than you to discuss cost segregation. Your firm, ICS Tax, specializes in cost segregation. Perhaps you can tell us a little more about yourself as well as like ICS Tax.
Yeah, gladly. I'll start with my firm. So ICS Tax, we're not an accounting firm. We don't prepare tax returns or anything like that. We're a specialty consulting firm that focuses primarily on those who invest and develop real estate. We've got about 40 people across the country with boots on the ground in 14 states. We do a lot with cost segregation studies. We do a lot with energy efficiency incentives, both for commercial buildings as well as residential ones. We do a lot with fixed asset reviews and provide other services that are valuable to those who invest in real estate. My background, as you mentioned, I'm a CPA and attorney. I'm also a certified cost segregation professional. Very proudly have been the president of the American Society of Cost Segregation Professionals, and I'm very active in the organization today. Helping people with their taxes is a passion of mine, and finding ways to reduce their income tax liabilities is just something that I have always enjoyed doing. And I'm very pleased to be here today.
No, we really appreciate your time. Before we get into cost segregation, what I was thinking, perhaps you can define, or we can start with depreciation as well as bonus depreciation for our audience, because if you covered, like the fundamentals, then the whole conversation would make more sense, I assume.
Yeah, that's a very good way to start. So normally when a taxpayer makes an investment into a building, if it's a residential property, they need to spread out their deductions over 27 and a half years. And if it's a commercial property, or if it's like a short-term rental, which is kind of akin to a hotel, the tax deductions are spread out even longer, over 39 years. So you have a business, it generates income, you need to have deductions to offset that income. But when you make an investment into real estate, those deductions, as I said, are spread out over a very long period of time. So the goal of a cost segregation study is to carve out building components that have more favorable tax attributes. So for example, what's called personal property. Those things can be depreciated more rapidly rather than 27 and a half years for residential or 39 years for commercial. They're typically depreciated over 5 years using an accelerated method. Quite often they qualify for bonus depreciation, depending on what year it's in. It might be something that is eligible for 100% bonus depreciation, where you can immediately deduct the entire cost of it, or 80%. It depends on the year the asset was acquired. Examples of personal property, so that could include things like carpeting or vinyl ceramic tile flooring. It could include the kitchen cabinetry and the appliances and special purpose electrical systems. So, for example, the outlet underneath the sink that's dedicated to the garbage disposal, or if you have a microwave in the kitchen and there's an outlet behind that microwave, all those things can be treated akin to equipment rather than just general purpose electrical, and those have much more favorable tax attributes. Similarly, the land improvements of a building. So when you buy a building or a short-term rental or anything like that, chances are you're going to have land improvements. These could be driveways and walkways and the landscaping. They could be things like fencing or retaining walls or storm sewer retention ponds. There were a lot of different things that would meet the definition of land improvements. And again, those are depreciated much more rapidly than just a general building. And those are also eligible for bonus depreciation, which would mean that you'd be able to depreciate these much, much more rapidly. And again, the goal is to accelerate the timing of these tax deductions where it'll free up your cash by paying less in your tax liabilities. We're not creating any new tax deductions, but we're front loading them where you can take that money and reinvest it into buying more properties, or if you want to buy something fun, a new sports car or a bass boat, anything like that, it's up to you.
Yeah. No. This was very good. So I understand a cost segregation study is a very powerful tool for like investors, right? So
Right.
perhaps can you give us a real like life scenario and break down the power of like kind of cost segregation? Because numbers always make more sense for our audience.
Yeah, absolutely. So, we have a taxpayer who is a very wealthy individual. He makes about $500,000 annually from his wages. And before I go into the example a little more, I need to talk about active income versus passive income, because I know a lot of your audience members invest in short-term rental properties, and this matters a lot to them. So we've got two kinds of income. We've got active income, which is basically money that you're working for. Quite often that's your wages, or if you're a dentist and you operate a dental practice, the money that you earn from that is active income. And then you have something called passive income. And these are activities that you're not heavily involved in. Quite often, most real estate activities are passive income, presuming that you're not a real estate professional. If you operate like a coin-operated car wash or coin-operated laundry, where these items you don't really materially participate in, you're just sitting back and collecting the revenue, those are passive activities. And the IRS requires that you treat the income from these activities separately. And what you cannot do is take passive losses and use to offset your active income. And that's where the short-term rental loophole comes into effect, where, normally if you just rent a house and you're using it as a long-term rental, then we could do a cost segregation study and we can generate a lot of tax deductions, but unless you're making a significant amount of income from that property itself, you can't use it to offset your active income. For most of the folks that you deal with, that's going to be like their wage income. What the short-term rental loophole does is, rather than operating the property as like a long-term rental, you're renting it for a shorter period of time, generally 7 days or less. And if you're doing that, it becomes more akin to operating a hotel. And the requirements for you to participate in that activity are very low. Most people can do it if they're just checking on the property periodically, or if they're booking the reservations for it. They can actually treat the deductions from a cost segregation from a short-term rental and use it to offset their active income. And another benefit too is, a lot of the people that we deal with they're using borrowed money to buy these short-term rentals. So maybe they're putting 20% down and they're doing a study and they might be getting tax deductions greater than the 20% down. That's going to be offsetting their active income, their wages. So going back to the example, we had one client who was making about $500,000 annually, and he purchased a short-term rental property. It was a vacation property. It was something that you might find on Airbnb, where he would basically rent this thing out, and he could use the tax deductions from a cost segregation study to offset his his wages. And when we did it, we generated about $250,000 of tax deductions, which could offset his active income, his wage income, and basically generate a paper loss for him. So it was pretty exciting for him. What's nice too is, you do this once and it reduces your taxable income in 1 year. You can keep buying these properties and build up a huge portfolio of short-term rentals. And these properties typically appreciate very quickly. And that appreciation isn't taxable until you sell it, or perhaps if you pass on and it goes to your heirs, and then it would get a step up to fair market value. But if you keep investing in these properties, the tax savings are massive for you. So it worked out really well for him.
No, no, no. I couldn't agree more with what you just explained, right? And what better to spend that tax refund on than the down payment on another house to use for bonus depreciation next year, which generates a big refund next year, which can use for another down payment the year after, which generates another big refund the year after. And now you are scaling your short-term rental portfolio. A decade later, you got about 8, 10 properties. Money has inflated, rents have gone up, but your mortgage is fixed. Yes, you are making a lot of money with your short-term rentals, and most likely all of your properties appreciate in value. And what I can tell you is, savvy investors, just like you said, use segregation, cost segregation, and accelerated depreciation effectively to acquire more real estate and build generational wealth over time.
Yeah, absolutely. And the short-term rental loophole, I mean, it has like a negative connotation, and perhaps it's a bit of a misnomer, but we're exactly following the tax rules. And it's not like we're doing some sort of off-seas foreign company to shelter your income or anything like that. We're just following the tax rules to do that. Similarly, with cost segregation studies, the IRS is fully aware of these studies, and they published a guide, an audit techniques guide, on what makes a good cost segregation study. And if you hire a cost segregation professional who's experienced and knows what a good cost segregation study should look like, generally any certified cost segregation professional would be qualified to do such a study. The IRS is going to look at it in the unlikely event of an audit, and they're not going to have any changes. So it's pretty exciting and very low risk, and it's a fantastic way to generate wealth.
Yeah, I couldn't agree more. So my next question to you: when does using a cost segregation study make sense?
Yeah, so number one, you need to have the income to benefit from the accelerated tax deductions. So if you're retired, you're not making much income, and you purchase a property, and that property really is just kind of breaking even, it might not make sense to do a cost segregation study. Or similarly, if you purchase a property and within a couple of years, you're planning on selling that property, rather than accelerating the timing of tax deductions from like 27 and a half years or 39 years to 1 year with bonus depreciation, you're only getting like a 2 year or a 3 year accelerated tax deduction. So it might not make sense in those situations, but if you're paying more taxes than you would like, and you have a significant amount of income, and you don't want to sign that away to Uncle Sam, the short-term rental loophole in combination with a cost segregation study is a fantastic way to go.
Yeah, yeah, no, no, that was a like a very valid point. And based on my experience, there are a couple of signals that a cost segregation study might be right. Like for an investor, like you said, like high tax bracket. If your bracket is over 24%, uh, I think like this is a good sign that a cost segregation study could be beneficial to you. And higher tax brackets mean higher savings with like depreciating properties, right? And the second thing
Right,
I'd like to like kind of point out, purchase prices over 350K or like kind of $400,000. Large properties see more benefit from cost segregation studies because of their significant value. A good like kind of breaking point for this is, I believe, 350K based on my experience, right? And this is where the benefits begin to outweigh the costs, right? But
right.
yeah, so my next question, how consulting with a certified cost segregation professional and a real estate CPA help STR owners?
So they usually, the cost segregation professional and the CPA work hand in hand. And what I mean is, the CPA would recognize that they have a client that they're paying a huge amount of taxes, and they already invest in real estate, or they're planning to invest in real estate, and they're looking to reduce their tax liabilities. But again, a CPA is not going to generally be experienced with construction costs and the specific tax treatment of every single component that goes into a building. And that's where they partner with a cost segregation professional. So most good cost segregation firms, they would start out with a benefit estimate where they'll ask for some basic information about the property. They'll ask for the address, if there's an appraisal, if there are closing statements. All of that information would be very helpful. If the property was placed in service in a prior tax year, that's no problem. We can still do a cost segregation study, even without amending. We would just ask for a copy of the tax depreciation schedule, and they would prepare a benefit estimate that would list out the additional deductions that the study is anticipated generated. It'll list the fee, which is typically going to be a fixed cost, and the taxpayer and their CPA can review it and say, okay, this project is going to generate, let's say, $250,000 of additional tax deductions. How's that going to look for me? How's it going to flow through my income tax return? And that's where the CPA adds value, where they can model out the benefits of a cost segregation study using their tax software, and it'll generate the potential tax savings of doing such a study. So generally, the CPA and the cost segregation professional are going to work hand in hand to make sure that a cost segregation study is going to be right for the taxpayer.
No, no, this is all great info. Again, thank you, Alex. This was really great. As always, if you'd like to learn more about our services, check out our website, strtaxloophole.com. Thank you all, and see you on the next episode.